Welcome. I'm Mark Armbruster, president of Armbruster Capital Management. I'm here today with Alex Botte. Alex Botte, CFA, CAIA, is a client solutions portfolio specialist at Two Sigma Advisors. In this role, she creates content on factor analysis and investing, contributes to research-related feature development for Two Sigma's Venn platform, which is software used by investors to manage risk and return in their portfolios, and she consults with Venn users on portfolio construction and investment evaluation. Alex was previously at AQR Capital Management, where she most recently served as a product specialist, where she was responsible for portfolio monitoring and client communication of the firm's global asset allocation strategies. She also worked for the Advisor Solutions Group, covering business development and investor relations for financial advisors and multifamily offices, which is where we became acquainted with Alex because she covered our firm. Prior to AQR, Alex worked in prime services at Barclays, and she holds a BS in Applied Economics and Management from Cornell University. Alex, welcome. Thanks for joining us today.
Thanks, Mark. Really appreciate you having me.
So you do a lot of factor-based investing in your work. Can you explain to us what a factor is and what factor-based investing is?
Maybe we could start by introducing factors through a non-finance example. So imagine that we wanted to create a model that had a bunch of different variables that could explain the monthly rent prices of New York City apartments. And without looking at any data, we could come up with a host of ideas. For example, we could look at variables like the square footage of the apartment, the number of food delivery options in its vicinity, its distance to the nearest subway stop, and maybe like the number of bedrooms it has. So if we explore this model in a little bit more detail, we'll find that some of the inputs, like the number of bedrooms or the apartment square footage or the number of food delivery options in its vicinity, are going to have a positive relationship with the price of the monthly rent. So for example, all else equal, the greater the number of bedrooms of the apartment, the more expensive it's likely going to be. And if there's not a lot of good food delivery options nearby, that means less choices for the tenant when they want to have a night in. And it could also mean that the apartment is not near restaurants and activity, making it a less desirable area. So these could, in theory, push down the price of the apartment. And then on the other hand, there's going to be variables that are negatively related to the rent price. Distance to the subway might be a good example of that. If you have to walk further to the subway, you'd expect to pay less for that apartment, all else equal. So each of the variables that could impact apartment rent, these could be considered factors. But if we kind of move from this non-finance rent example to investment management, we at Venn and Two Sigma define factors as variables that can explain risk and return across a diverse set of investments. So let's move to a stock example. Microsoft and Google. These are obviously two separate tech stocks, but when it comes to movement in their stock prices, there's going to be some common factors that exert an influence. For example, both stocks are going to be sensitive to fluctuations in the overall equity market. So if there are news or events or changes to fundamentals that impact the overall equity market, it's likely going to have an effect on both of these stocks. An example here might be the Federal Reserve was more dovish than expected at a meeting, and they cut interest rates by more than what the market was expecting. And this might, the overall market might rally on that event, and that would positively impact the prices of both Microsoft and Google. Another factor might be technology-specific risk. So say regulatory bodies announce that they will be conducting investigations into major tech firms' data privacy practices. This could have a negative impact on tech stocks specifically because any fines or penalties that result from those investigations could have an impact on the financials of those tech companies being investigated. So this type of news could impact both Microsoft and Google, but it might not have an application to stocks in other industries. And of course, beyond equity and tech market risk, Google and Microsoft, it's not like they're moving together in lockstep. They're separate stocks, and they have their own idiosyncratic returns that are specific to each company. And these returns are uncorrelated to the equity market or the tech industry as a whole. An example of these idiosyncratic returns could be the announcement of a new gadget. Say Google announces a new Pixel phone, and it's expected to bring in additional revenue for Google. This idiosyncratic component is not considered a factor because it doesn't explain the risk and return across a diverse set of investments. It really only affects the stock price of Google. So how can investors actually use these factors? Well, a lot of the factor talk in the industry has been centered around products like smart beta or risk premia. And these products come in the form of ETFs or mutual funds that seek to capture the returns offered by certain factors like equity market risk or tech-specific risk. And we'll get into some other factors as well. But I'd also like to note that investors can use factors in their portfolio construction and investment decisions. And they can do this from both a top-down perspective by asking themselves how much exposure they want to various risk factors. And they can also do it from a bottom-up perspective by evaluating and analyzing the risks of certain funds or even individual securities like stocks.
So how are factors identified? What's sort of the criteria for broad acceptance of a factor?
We're defining risk factors as discrete, describable sources of systematic risk and return across a diverse set of investments. And so risk factors in this framework should be definable, right? You should be able to define exactly what a risk factor is. And more importantly, stocks that exhibit that definable characteristic should show evidence of co-movement. And that latter part is critical because it indicates that there's some common source of risk that causes this group of stocks to move together. So I'm going to give you an example. Imagine a factor that's not actually a risk factor. So we'll define it as stocks that start with the letter A. This is certainly definable. It's easy to define and identify A company stocks. And to build a simple factor, we can just buy company stocks that start with A, and we can sell or short those stocks that don't start with A. However, if you think about it, there's not really an economic reason that stocks of companies that start with A should move together. And actually, the data likely wouldn't bear that out. In other words, there's no shared risk among A name stocks, and there isn't any obvious behavioral bias that would cause investors to over or undervalue A name stocks. So let's compare this fake A named factor to a well-documented factor like small cap. And small cap is defined as stocks with relatively low market capitalizations. So that's definable, which is good. But stocks that have low market caps are also exposed to a common risk. They tend to be riskier than their larger counterparts. They're more exposed to downturns in the equity markets. For example, recessions could affect the viability of a small cap company more so than a larger one, as worsening economic conditions are associated with a systematically larger decline in sales and investment for smaller firms than larger firms. So that's an example of a real factor. And typically, factors are studied and observed over many years, even decades, to understand why they might exist and whether they provide long-term positive returns.
I read a study a few years ago that indicated there'd been over 400 factors identified in academic research and published in academic journals. Are there a few that are more important or more widely accepted than others?
Yeah. I mean, researchers have discovered an ever-increasing number of new factors that seek to explain more risk and more return within stocks and even some other asset classes. But unfortunately, not all of these factors are created equal. Some factors come with a risk premium, meaning that risk that they come with has a positive return associated with it. So those factors compensate you over the long term. And then others just introduce unrewarded risks. So it's worth exploring why factors exist so that we can understand if they will continue to provide a positive return premium in the future. And there are three reasons why a factor could provide a positive expected return. And those three reasons generally fall into these categories. One is risk, second is behavioral, and third is structural. So starting with the first, the risk-based explanation for factors is rooted in the idea that factors introduce risk. In the efficient markets view of the world, investors are rational. So any return from a factor is reward for bearing some form of risk. And the investor needs to understand their factor exposures in order to be aware of these risks. Exposure to the general equity market is an example of a factor that can be explained by risk. Investing in stocks is risky, right? You're exposed to the economic growth and profitability of companies, and there's a risk that the money that you invested is not returned to you. In fact, companies could go bankrupt, and as a stock investor, you're actually one of the last in line to recover any investment. So investors in stocks expect to be compensated for taking on that risk. Now, the next reason is behavioral, and the idea behind this is that not all investors do behave rationally. There are certain irrational investor behaviors that can lead to security prices that deviate from their fair value. For example, investors may initially underreact to positive news about a security, preventing that stock from reaching its fair price. And this underreaction could occur from behavioral biases like investors anchoring to a prior price estimate for that security or falling victim to what is called the disposition effect. And the disposition effect is an anomaly that's been studied in behavioral finance, and it's the tendency for investors to sell securities that have recently appreciated and ride out securities that have depreciated. And the underlying idea here is that investors like to win. It feels good to lock in gains more than they like to lose. It doesn't feel good to lock in your losses. So these types of market inefficiencies that result from behavioral biases can create return opportunities that can be captured through exposure to factors, one of which is momentum, which we'll cover in a little bit more detail later. And then the final explanation is structural. So an example of a factor that might be explained using structural reasons is the low risk, low volatility, minimum volatility. There's a lot of different names for it, but that factor. And the reason behind this low volatility factor is that some investors face explicit leverage restrictions, such as those established by the Investment Company Act of 1940, which impacts mutual fund managers. And one way to aim for higher returns than the overall market is to use implicit leverage by investing in higher beta or higher risk securities. So this type of activity can bid up the price for higher risk securities, creating a return opportunity for others in the market that are willing to step in and accept lower beta securities. And in order to be attracted to those lower beta securities, there should be an associated return premium for them. So some factors can be explained using risk, behavioral, structural, one, two, or even all three of these reasons.
So, we've got these factors that have been identified in the research and show up in the empirical data. But just because factors have worked in the past, how do we know that they'll continue to work in the future?
Yeah, I mean, it's a great question, because even if a risk factor has posted positive returns historically, what matters more to you as an investor is how that factor is going to perform in the future. So understanding why it exists can help you determine whether that risk factor should continue to carry a return premium. And that's why it could be helpful to think through that framework that I just talked about, asking yourself, does this factor have some sort of justification for its existence historically, whether that be compensation for risk or earning returns from market participants' behavioral biases or opportunities that arise for structural reasons.
How do these factors all work together in a portfolio? Should a portfolio be all factors, or should it be more of a core and satellite where factors are sort of structured around the periphery of the portfolio?
We think of it this way. Your portfolio has returns that can be attributed to common, well understood risk exposures or factors. And then there is some return that can't be attributed to these common sources. And we call that return residual. And the residual component is idiosyncratic, and it could be the result of a manager or an investor that has true alpha or skill. But it could also be the result of just random luck. And if you see right here, we're actually going to pull up a fake portfolio that's made up of a bunch of different mutual funds across many different asset classes. You can see on the left the different asset allocation. We have equities, bonds, commodities, real estate, and some alternatives. And we can decompose the risk of this portfolio into various factors. So there's these bars that are associated with various factors that we look at. And at the bottom, there's a row that represents residual, and that's the amount that's left over that's unexplained by factors. And you can see here that even though this portfolio is allocated across all of these different asset classes, there's a lot of risk that is dominated. Equity is dominating the risk of the portfolio. And so if you think about like a key tenet of good portfolio construction, it's diversification. And that applies when you're building factor-based portfolios. You don't want to rely on a single risk factor to generate returns for the portfolio. You could actually enhance your risk-adjusted returns by allocating across a variety of factors that have associated positive long-term returns.
Does that mean that a factor approach involves taking on even more risk?
Well, using factors as opposed to, say, asset classes to build portfolios doesn't necessarily mean taking on more risk. It does allow investors to have a clearer understanding of it and be more intentional about the risks that they're taking. And this is for a couple of reasons. The first is that risk factors are granular. Traditional asset class allocation may disregard overlapping risk drivers across asset classes. And if you ask how this might happen, let's take the Bloomberg Barclays Global High Yield Bond Index, for example. From an asset class perspective, the index is made up of a combination of corporate and emerging market bonds. So it's all bonds, right? Corporate and emerging markets, but the asset class is bonds. If you look at it, though, from a risk factor perspective, the index is exposed to credit risks, equity risks, and foreign currency risks. Therefore, bonds, at least as represented by this index, are exposed to more than just downturns in the credit bond market. We'd expect downturns in the equity market and foreign currency fluctuations to impact the index's performance as well. So if you were thinking about, diversifying maybe your all-stock portfolio by adding in high-yield bonds, you might think that's diversified because your dollars are now spread across two different asset classes, stocks and bonds. However, because both of these asset classes are exposed to the equity market, the portfolio might not be as diversified from a risk perspective as it would appear to be. So these risk factors can help you zero in on more granular drivers of portfolio risks and return. And if a portfolio is diversified across many different types of assets, risk factor analysis can help you understand the elemental exposures of your portfolio once the risks are aggregated across all of the assets. And then the second is that risk factors are designed to be uncorrelated. So as I mentioned earlier, asset classes might have overlapping risk drivers, which would result in positive correlations. So in that prior example, high yield bonds and stocks might be positively correlated because they both share exposure to equity risk. Further, asset class correlations can be meaningfully high during market disruptions, and that's exactly when diversification is needed the most. The blue bars that you'll see here in Exhibit 2 display correlations among asset classes during the global financial crisis. And we're defining the global financial crisis as September 15th, 2008 to March 9th, 2009. And the gray bars demonstrate correlations among risk factors. And you can see on average, the asset classes, the blue bars, are a lot higher and more positive over this time relative to the factor pairs. So I guess in summary, risk factors are both more granular. They get to a deeper level of risk, and they're also designed to be less correlated.
So value is one of the more famous factors that you hear about, but it's underperformed the market, or it's underperformed growth stocks for the past 10 years. How long do investors have to wait for factors to outperform? And is it possible that this factor is no longer effective?
Fortunately, factors can go through many years of underperformance, but still be effective over the long term. In the case of value specifically, the canonical measure of value is book to price. And that value measure has been in a drawdown in the US since the global financial crisis. And that's led many market commentators to question whether value investing is still alive. The book to price ratio seems to have become less effective over the years at identifying value stocks, perhaps because the accounting book value does not take into account intangibles that have become a significant contributor to firms' profitability and operating efficiency, and hence their fundamental value in this new economy. My colleagues actually recently wrote a white paper called Diagnosing the Recent Decade of Drawdown in Value, and I'll highlight an interesting finding of theirs. The profitability and operating efficiency of stocks traded by a book to price based value strategy underwent a regime change around the global financial crisis. So the average profitability and operating efficiency of stocks identified as overvalued by the book to price based value strategy has increased since the GFC, and vice versa for undervalued stocks. And this recent disparity between book to price and these other metrics does explain to some degree the observed underperformance of the strategy since the global financial crisis. So value investors that incorporate intangibles in their fundamental valuation models would have actually profited over the last decade. So in this sense, the story of the recent decade-long drawdown of the book to price-based value strategy may be that of book value becoming an incomplete fundamental valuation model for firms over that period.
So there are numerous studies that show that index investing has been better than actively trying to pick stocks that outperform the market. Is factor investing ultimately an active strategy?
Yeah, well, first we should define passive and active management as it relates to investing. Passive exposure to a particular market segment can be achieved by investing at market cap weights. And this can be achieved through the use of index funds or through some passive program that's developed at Armbruster Capital or somewhere else. While you won't outperform the market through a passive approach, you won't meaningfully underperform it either. But of course, you can lag the market because you're paying fees and other expenses, which are typically very low for passive investing. Active management is the attempt to outperform the market based on your skill or the skill of a manager that you hire. And it typically costs more than a passive indexing strategy. But you as an active investor are more than happy to pay the fees and take on the tracking error, the risk relative to the market, if you believe that your skill or your manager's skill in that market is great enough that you can outperform to cover those fees and costs. So to the extent that you're hiring managers that seek to provide you with risk factor exposures within asset classes, so say you're hiring a value manager or a momentum manager, and these are like factor-based funds, they're likely deviating from market cap weights, and so therefore they're providing you active exposure. So in that sense, yes, factor investing is an active strategy.
So we talked a bit about value stocks, how they've underperformed, and that makes them historically cheap right now, at least relative to growth stocks. How much does valuation matter within factor investing? Can you use valuation as sort of a factor timing tool?
This question effectively gets into the topic of factor timing. Well, what is factor timing? Just as one would expect a cheap security to outperform an expensive one, or a recent winning stock to continue to outperform a recent losing stock, that same concept could apply to a factor. And there's been plenty of research on this topic by others. For example, you could look at the valuation spreads to time factors, where you measure the difference in book to price or price to earnings between the cheapest and the most expensive stocks in your factor portfolio, and use that to identify when a factor becomes cheap compared to its history. As cheaper stocks continue to get cheaper and more expensive stocks continue rising, the valuation spread is going to get wider and the value factor will be underperforming. But at the same time, the opportunity set is increasing. And the tricky part is knowing when that valuation will turn around. If one times a factor in this way, you risk rotating in too early and withstanding some underperformance ahead of the factor's recovery. And we should also note that the turnover and transaction costs associated with an active factor timing strategy can be higher than that of a relatively static multi-factor portfolio. But despite these challenges, there has been evidence that if you time factors using a variety of inputs like factor valuations, factor momentum, the phase of the macroeconomic cycle, you can increase risk-adjusted returns. But this requires a good amount of skill because timing factors with precision can be really difficult, especially over short periods.
There's a big emphasis on cost these days and driving down investment-related expenses. Is it expensive to implement a factor strategy?
There's a spectrum of cost when it comes to implementing a factor strategy. We like to use the triangle shown here to illustrate that spectrum. So at the bottom of the triangle, you have the most liquid, low-cost factors that are very accessible and relatively easy to capture. So these include factors like just getting exposure to general equity market risk and global bond risks. There are mutual funds and ETFs that offer these exposures for next to nothing. And above that, you have this what we call secondary macro factors. And these are still asset class based factors like equities and bonds, but they're a little bit less liquid and they have lower capacity. So these are things like emerging markets risk and foreign currency risk. These are still relatively inexpensive, but they're more costly than obtaining what we call core macro exposures, which is the level below. And then the third layer up, you have what we call style factors. And these are trying to capture factors within asset classes. So we've talked a lot about capturing the value effect within stocks. We would classify that as a style factor. You can access these types of factors in a few ways. One is through a long-only, actively managed ETF or mutual fund. So these are portfolios that are long the overall equity market, but they tilt to or they overweight stocks that exhibit positive characteristics of the factor that you're trying to capture. So a value ETF might be tilting or overweighting cheap stocks, for example. And these are relatively inexpensive as well, like less than 1% fees usually, and sometimes way less than that. But they can give you, mostly market exposure with some style factor exposures on top. If you wanted to capture these style factors in a purer way, you would have to go long and short. These products do exist, but they tend to be more expensive. Fees vary, of course, but they're in the 1% to 2% range. And then at the top of the triangle here, you have alpha, or the idiosyncratic return that can't be explained by common well-known factors. Alpha has very low capacity, it requires skill to consistently capture, and is therefore higher cost. Now, all of that I just mentioned relating to how expensive factors are is from a fee perspective, but you could also consider cost from a transaction cost perspective. The bottom two, the core macro and secondary macro factor exposures, are relatively static in nature and have lower turnover and transaction costs than style factors, which in turn have lower turnover and transaction costs than alpha. So that same logic applies to transaction costs as it does to fees. Costs increase as you move up this triangle.
So we've mostly talked about stocks. You've alluded to other asset classes. Can factors apply to other asset classes beyond the equity market?
As you said, we spend a lot of time talking about style factors within global stocks like value or small cap, but these concepts can also be applied to other asset classes like fixed income and currencies. For example, on the Venn team, we look at the carry factor within global fixed income and currency markets. And the idea is that bonds or currencies with higher yields outperform those with lower yields, all else equal. And there's some risk to this factor, as when there's a market crash or a liquidity event, investors tend to flock to safer, lower yielding bonds and currencies. And this is referred to as a carry trade unwind, and the factor can have significant losses during these periods. So if an investor accepted this risk, they've historically achieved positive returns over the long term. So if we kind of loop back to, why do factors exist, this kind of carry factor would fall within the risk camp, the first reason that I provided. But Mark, to answer your question, factors do apply to other asset classes as well.
So ultimately, if expected returns are higher with a factor-based approach, why wouldn't everybody use factor-based investing? And if they did, would it still work? Is there some critical mass out there beyond which you can't go?
Yeah, like you said, I mean, not all investors follow a factor-based approach, and if we go back to the reasons why factors exist, remember risk, behavioral, and structural, these reasons might prohibit investors from investing in factor-based strategies. For example, maybe they don't want to or they can't accept the risk of a certain factor. And to answer the second question about what happens if more and more people start investing based on factors and if that would erode the returns earned from this type of investing, well, as we mentioned earlier, to the extent you hire managers that seek to provide you with risk factor exposures within asset classes, such as a manager that's giving you value exposure within stocks, they're likely deviating from market cap weights, and therefore they're providing you with active exposure. And active management is a zero-sum game, meaning that if one active investor is long a stock, then there must be another active investor on the other side selling it. And if we take the perspective of a factor investor concerned about erosion of their returns, if suddenly more investors start pursuing the same factor investing strategy, we really care about who is it that is converting to factor investing. It could be one of two types of investors. One, it could be people on the other side of your strategy. So for example, if you're buying value stocks, somebody else must be selling value stocks. So we can call these people other siders. If your value factor strategy ends up being a good one, maybe the other siders are losing money, since they're counterparties to your trades. The second type of investor are your competitors, and you're not the only one employing the value strategy. There's others that are implementing value strategies, through systematic factor funds, but they could also be, intentionally or unintentionally buying value stocks through a fundamental stock picking approach. So maybe there's a stock picker out there that handpicks 15 stocks, and maybe those stocks are value stocks, and they intentionally or unintentionally have that value exposure. Regardless of the implementation, whether it's systematic or a handpicked stock picker, these investors are competing with you for the other siders, and the competition will presumably diminish your returns and is harmful to you. So if your competitors are converting to systematic factor investing, that might be a wash and not impact your forward-looking returns because those investors are still buying value stocks at the end of the day. But if the other siders convert to factor investing, that's problematic because you now have more investors chasing the same returns.
Well, Alex, thank you very much for joining us today. Your insights and your time were invaluable. And thank you to our listeners for joining us on this episode of Armbruster Capital Management's InvestEd VidCast Series. If you have questions about factor-based investing or any investment topic, please feel free to reach out to us at any time.